Income statement. And the income statement is one of company's core financial statements that shows their profit and loss over a period of time. The profit or loss is determined by taking all revenues and subtracting all expenses from both operating and non-operating activities. The income statement is one of three statements used in both corporate finance, including financial modeling and accounting. The statement displays the company's revenue, costs, gross profit, selling and administrative expenses, other expenses and income, taxes paid, and net profit in a coherent and logical manner. In this example, you can see an format of income statement. First, you can see sales, then cost of goods sold, including material, labor, and overhead, which results in gross margin, as we have to subtract cost of goods sold from sales. Then we have operating expenses that are required to run any business: selling expense, administrative expense, depreciation, and amortization results in operating income. And then we also include other incomes and expenses, that is interest revenue, interest expense, and other items. Lastly, we have to deduct income before tax, and then at the result we get net income. Profit and loss income statement. Retained profits are part of their owner's equity recorded in the balance sheet. However, the balance sheet does not tell us how the retained profits were earned by the business. This is the job of profit and loss. The profit and loss shows the income, revenue, and expenditure of the business over an accounting period, usually 1 year. It is a record of business transaction in the accounting period. The difference between income and expenditure of the business is called profit. To understand how the business makes its profit, the income and expenditure is split into different categories, and a number of different profit figures are reported in the profit and loss. The link between the profit and loss account and the balance sheet. The final profit figure for a business after deducting any distributions to the owners is retained profit. The profit and loss expense how this retained profit is earned shows shows it. The retained profit is then added to the reserves in owner's equity in the balance sheet. Therefore, assuming there are no changes into any other reserves, the difference in owner's equity and hence net worth from the previous balance sheet to the current balance sheet is equal to retained profit. So the profit and loss explains the change in net worth from one balance sheet to the next. So, for example, a sales revenue is recorded and income when the sale has been made and on a credit to customer who has 2 months before they need to pay, and a purchase it recorded expenditure even when the purchase that has been made on credit from a supplier that allows a month before payment, as well as matching income and expenditure in this way to the period of to which they relate. Income and expenditure are also matched to each other so that the possible expenditure is recognized in the same period in which it generates sales.